Well, we had an eventful weekend. First, with the passing of our 41st President of the United States, George Herbert Walker Bush, that will memorialize with a day of mourning on Wednesday. Markets will be closed on Wednesday as a result. Also, the widely anticipated dinner in Argentina between President Trump, as well as the Chinese president, resulting in some positive news potentially coming out. So far, only reported by the U.S., but some positive news that can impact risk appetite and investor sentiment heading into the new year. So I'm going to break down what it looks like now from a technical perspective and what we should expect to see in the short term and with a potential new intermediate run. So let's go ahead and get started. Today is Monday, December the 3rd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 and how it finished today. You can see we kind of closed right where we opened with a smaller range after the gap. The intermediate line has risen up above into the upper half of the chart easily now, into the upper half of the chart. Remember, the dark green shading means that you have the green line above 50 and rising. If you look at the yellow line here, that's the moving average. That's this number. Friday it was at 27.1694. Today at 27.17. So it turned higher. We're above a rising moving average now, which means it's turning green tomorrow. So green moving average and dark green shading, that's bullish. That's a bullish posture. Now we embark on a 1 to 3 month intermediate, potentially a 1 to 3 month intermediate run. That's what we expect, right? Especially with the near term line easily in the upper half of the upper reversal zone. Now it's been above 50 for how many days here? It's been 1, 2, 3, 4, 5, 6 days. The near term line up above 50. So we're most likely going to get the 7 to 12 day normal run, which is actually a good sign because it wouldn't have been surprising to get a shorter run considering how low the intermediate line was. Of course, you got Fed speak, Chairman Powell on that day lifting the market, and then of course the trade news over the weekend lifting it here. So it definitely had its help beyond the technicals to get to where it's at. You can see closing above this falling trend line that we have coming down here. Market sentiment's turning higher now at 33.56. So you can see both the green and the orange lines are rising. Near-term line also rising, but that doesn't. As long as it's above 80, that's what matters there. So a bullish posture remains bullish, expected to be bullish now for a while. It doesn't mean we won't have multiple near-term highs and lows like we did here and like we did here. So we're going to have pullbacks, and the pullbacks don't mean that things are over. Of course. If right now on the next near-term pullback, we'll have to keep moving this up if it keeps going higher. But the next near-term pullback, you'd expect to come down into this 27.35 area as we approach these old high points. We didn't quite get up to that 28.12 area here. We got up to 2800 at the high of the day today. But that's where your pullbacks will be. 2700 would be the bottom end of this Fibonacci retracement zone as of right now. Of course, we can continue to move higher until we get the pullback. Usually, at the beginning of intermediate runs, you tend to have longer near-term rallies. You had that first one that only lasts a few days, but once you get across 50, now you're expecting 7 to 12 days, more on the end of the 12-day side of things, until we get to that 1 month mark and we start to dial it back. And towards the end of the intermediate rally, the near-term runs get really short. So you can see even right here, just a few days on all of these. So that's where we're at right now. So we're at day 7. We got potential. We got more, or excuse me, day 6. Sorry, we've got. We could double this run and still be in a normal 12-day time frame. You look at the Dow Jones Industrial Average, same pattern, right? Bullish posture, it's crossing above 50. Moving average rising now with the green line. The Nasdaq Composite, dark green shading finally, getting above 50. Bullish short-term sentiment. The moving average not rising yet, so it's going to be yellow for one more day at least. And then the Russell 2000, it is turning up slightly higher, so tomorrow will turn green, and it's above 50 now, so We've got the bullish posture there, closing above a lot of different highs here. Not quite to that November high on any of these. You can see getting closer on the S&P and the Dow, and you can see the NASDAQ down a little bit, and the Russell still got some room to go to get to that high. Getting through these highs from early November would start the double bottom pattern that would give us a projection that you see shaded here, in this case up to about 3,000. Now it doesn't mean we'll get there in one fell swoop, right? It'll probably be a while, like I've shown you before. It's easy. It takes a while to get back these gains that you get, these declines that you get. So it'll probably be a while before we get to that 3,000, but you get through this 2812, and that's our target, right? That's the next target, and there might be an intermediate pullback before we get to that target. So a reminder before we look at some other charts here to subscribe to our YouTube channel. Mouse over this logo right here in the bottom right corner of your video, the Market Scholars logo, then click the red subscribe button that pops out. Also click the thumbs up icon down below the video. That tells me that you got something out of the video and you want us to do it again tomorrow. Really quick and easy way to give us feedback. You can do that right now while you're watching. Further down below, comment on anything that stood out to you from today's video. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link. Really easy way to subscribe. Follow me on Twitter for more content throughout the day like this. And join our Market Outlook community that we created on Facebook. Remember also, while you're on this page watching the blog or the Market Outlook, you can scroll down below, click on this heart right there. That will open up your Twitter account. You can like tonight's Market Outlook tweet there. Also, click on this image that takes you to your Facebook account. You can like our Market Outlook post there, and then finally click on this like button. Those 3 clicks, again, tell us you want us to do the video again tomorrow. If you don't want us to do the video, of course, you don't have to click on anything. Also, another quick note, we will have our Market Outlook video and classes tomorrow. There's our schedule for our classes tomorrow. On Wednesday, with the markets being closed, we will not have classes on Wednesday either. We don't have classes on days the markets aren't open, and besides our Saturday Q&A session that I do, and also we won't have a Market Outlook video that night either, for obvious reasons. Alright, let's get back to the charts, and you can see where we're closing so far this week, up above last week, now getting above the 50-day moving average clearly this week, and the 50-day moving average is back to turning higher again. So you can see the gap between the two rising up slightly. The Dow Jones Industrial Average, same thing. NASDAQ Composite, you're above the moving average. We gapped up above both those lines this go around. So that's a positive sign after dropping shortly below it. And of course, again, the Russell 2000s got the death cross here. So is it forming that low? What we're retesting right now, we'll see as we continue to get up here. We have to get above that high point, which is that kind of double bottom high, for us to say, okay, we've set the low point with the death cross, and now we're making our way higher. Let's take a look at the 3 green arrow chart for the S&P 500. We obviously have 3 green arrows there. If we take a look at, and a rising moving average now, right? That's going to turn green tomorrow. You take a look at the 2-line version of that chart, and you can see both the 8 and the 17-day getting above the 30-day. So that's kind of that last stage of a bullish reversal. Now, it doesn't mean we won't get a near-term pullback, but don't expect a move back down to these lows here. Now look for, more of a Fibonacci retracement area. Fibonacci retracement now is going to be coming down into that 2736 area, down to 2700, so about a 35-point range, where you'll find some support on any near-term pullback, especially with the MACD above 0 again, the stochastics above. Now, granted, it will make its run up to these levels around 20 or so before kind of flattening out. So that's when we'll really start to grind our way. So we'll keep our eyes on that. Stochastics also getting in the upper half of the chart, just like the intermediate line. The intraday chart gives us that higher high and higher low. We obviously open at the high of the day after the tariff news. And actually, we are actually a little bit higher in the after hours. If you take a look at the S&P futures, they came really darn close to the 4-week high point. You can see the 4-week high point was set back on the 7th in the early morning hours. We came really darn close to that. So the high of the day, you can see on the futures, was really early in the when the European session opened, and then there's the open in the U.S. session right there, so down a little bit. So that's what we see on spiders is the open in the U.S. session. So a lot closer in the after hours before pulling back early morning, the pre-market. And then finishing in the middle of the day, still above last week's high, above yesterday or Friday's high point. Also above the open from the Hakinyashi candle. We've already established we're well above the 200-day moving average, but there's the open. So we'd have to drop down here to that purple line. And then again, if I were to draw these Fibonacci retracements, redraw these to include the last few days. So we'd have to really come down, deep into the Fibonacci retracement zone to get a lower shadow in the Hakinyashi, which would not be as bullish as we are. So very bullish candle on the intraday basis here, trading in the upper half, easily in the upper half of the range. You can see the close yesterday at 270 or Friday 275.76. The low today at 277.51. So about a 2 point, a little less than 2 point, maybe 1 3/4 point gap there that we have to incorporate into the range for today. 1 3/4 gap. So the gap, we're looking at about almost a 4.5 point. About a 4.5 point range, so just a little bit above the average, and obviously above 1%. But volume at 103 million. So if you put that in context here, a 4-point range is right about where the average is. So we're still getting higher ranges. The volume is a little bit above the average, and of course the ATR relative to price also right about 1.5% today. So they're still high numbers, but they're not higher than those, right? That's when you worry. When these lines rise, these lines don't go up. That's not bullish usually. Usually it's bearish. So the fact, unless you're coming up off lows and they're slowly moving higher as you're kind of wrapping up and potentially heading to an exhaustion move. But that's not the case here. So we don't want the big moves. It's okay to get these average moves or smaller. You get a big move like this, you're most likely tomorrow going to get some smaller ranges. And like I said, even Friday we talked about the potential for some near-term weakness here in the next day or two. Well, now that we got this trade news out of the way, don't be surprised if we don't get a kind of a sell the rumor or buy the rumor, sell the news kind of effect throughout the rest of this week until we get that employment report on Friday. If you take a look at volatility, it's really now we got the trade out of the way, right? That event risk and volatility really came out. In fact, if you look at it on a relative basis, it's down into the neutral zone. Now, remember, the 90% will act as a support too. So it's not until we break that 90%, we hold that break, that's when this bullish trend, intermediate trend, is really taken hold. So don't be surprised if we don't bounce up a little bit here. Like again, in the near term only, to get some near term weakness, get that new higher near term high point that we bounce off of, then we'll probably have a much better chance of breaking through 2,800 on the next near term rally. Alright, so to summarize, we continue to be bullish. We're starting a new intermediate run with a good, strong, bullish near-term rally to begin with here. That's 6 days. It looks like it's got the makings of a 7 to 12-day, potentially even double-digit run, depending upon how this near-term pullback shakes out this week. Expecting to get a near-term pullback this week before we get a higher near-term low point and the higher possibility of a new higher near-term high point, and eventually breaking through that 2,800 and making our way back up towards the all-time highs. It won't happen overnight. It probably won't happen by the end of the year because we'll start to grind our way higher with smaller ranges and smaller volumes, especially as we head into the holidays. But as we approach the lower volatility levels, it's showing us that we're close to getting this volatility moderation over with. And now we can begin to grind and push our way higher slowly but surely, because that's how these bullish intermediate runs last, with the potential for multiple of these intermediate runs with a long-term run beginning here with how low market sentiment pulled back. So what do you think about that? Do you agree with that outlook? Do you disagree? There's a link popping out in the top right corner of your screen. Click that link, then answer the poll. Either click agree or disagree. If you click disagree, scroll down to the comment section below. Let me know, or let the community know what you're seeing that would suggest otherwise from what we summarized tonight. All right, you can see today was revenge of crude oil. Crude oil started the day very strongly up 4.5%. Emerging markets, of course, not surprisingly, started up really high too. They finished right around where we opened. Crude oil finished a little bit higher than where we opened, up 5%. You can see S&P 500 outpacing small cap stocks for most of the day. Small caps kind of caught up a little bit late. The dollar was one of the only asset classes down, which means gold was up today. Long-term bonds rallied throughout the day after opening the day with the worst performance, finishing the day up strong. So if you take a look at like the crude oil chart here, you can see that big move. Here's the today's move. We're starting the new day on the futures here in the after hours. But there's today's move, closing above the highs of multiple low days here. So strong bullish close there. When you take a look at it on a two-line version, take a look at crude oil here. It's been so beaten up. But you can see getting above its 8-day moving average finally. See how we held the 8-day moving average for a month plus. Finally getting above the 8-day, but we're not out of the woods, right? Yeah, we're getting a stochastic divergence. If you look at some of these other indicators here, like RSI, you can see how oversold we were for so long, but still got some room to go. If you look at the CCI here, which is usually used with commodities, you can again see how oversold we were, and a little bit of a divergence there in the oversold territory with higher lows, obviously with much lower lows. So, this was a big capitulation type move. And when you look at the volume for the futures contract, we've had some, a couple of down days with some really high volume contracts here on these 2 down days. If you look at it on a kind of more of a weekly chart, you can see the volume over the past few weeks has been well above average. So as we really dropped down, but it seems like last week we kind of have started to set the low point a little bit. So there's opportunity for crude oil. Remember, that's the same. That's kind of an anti-dollar trade, and that the same move that we'd expect to see in crude oil with the dollar making its turnaround, you'd expect to see in emerging markets. You can see emerging markets also. This is a weekly chart, mind you, but so far this week closing above, starting above the highs of all these weeks. So very, very positive sign here. Of course, if you look at the Bollinger Bands, we've got a relatively high bandwidth, but even with that, closing up above. Well, you can see. Let me zoom in here. There we go. Closed, opening above the Bollinger Band, and now making its way into a kind of a low end of of this volume before we get some more resistance on EM up into this area. Right, it'd be 43.39. So a couple more dollars up to the upside before you get another vacuum of volume until you get to this 46.5 level up there. That's a few bucks away. So we've got some opportunity for a little bit of a turnaround pattern in these emerging markets, making its way higher up above this 50-day moving average. The other pattern, the other asset class that had that move was long-term bonds. You can see also trying to do some kind of turnaround here. What that looks like, at least on the 10-year yield, you can see multiple weeks in a row now that 10-year yield continues to decline and sitting at an inflection point here, where it's got either the possibility of bouncing up or making its way through that line and dropping further towards these Fibonacci zone areas. Of course, one of the biggest impacts, so the 10 years kind of pulled in both directions from inflation expectations and economic growth expectations, or interest rate hike expectations in lieu of the inflation expectations. You can see the odds from March, despite the positive news over the weekend, the odds for a rate hike in March only rallied a little bit above 40% when you add those two numbers together. So that's still not very strong. Again, by now, if we're still on pace to get that rate hike in March, we should be at 60%, because the December should be above 80. The next meeting should be above 80 as we head towards it. It gets closer to 100, and when this is above 80, the one after that's at 60, and then of course the 275 300 for June would be, so here's December, March, and then June, that would be flirting with the 40% level. Now, of course, we're not anywhere close to that. So that's kind of your typical pattern, and we're not seeing that. We're not seeing that for March or June, even with the positive news of the weekend. Didn't really serve to help lift it up too much at all. And that's why you see, the 10-year yield really dropping. Of course, the interest rate hike expectations are going to kind of mirror these inflation expectations, which really jumped up here from the 27th up to the 29th and then the 30th over the end of last week. We dropped from 2.09 up to 2.17, so a big move higher. But you can see we've been dropping from 2.29 down to 2.09. So since the decline in the stock market, that's really brought inflation expectations down with them. And as these continue to move lower, the need for an interest rate hike gets smaller and smaller. You can see, the inflation expectations at the beginning of the year was at 2.3%, and we were below 2.1% when Chairman Powell came out with his the idea that we're closer to the neutral rate, right? In fact, here when we started, when we were doing we had that second interest rate hike in December. We've had the 3 hikes in 17, the 3 hikes in 18, going for 4, and by the end of the year in December, we were at 2.1%. That's when we had the first interest rate hike in the end of 2015. So right there, not as much of a need for one at the time because we were falling on on inflation expectations. But we got the first one there, and that was it, because you can see what happened to inflation expectations. So they didn't do any more until this rally. So we had the second one there, and then we've been doing it pretty much every meeting since, minus that March 17. We've been doing one ever since. So, but inflation's not any higher. The expectation for inflation is not any higher than it was almost 2 years ago. So again, another reason why the Fed's kind of holding off at 2%. This is kind of like exactly where you want inflation to be, running at a nice 2% plus a little bit level. From a sector rotation standpoint, interesting to see again with the move higher in crude oil and the weakness in the dollar, energy, materials, and industrials to a smaller extent, all improving. Of course, with the bounce off these lows, technology and discretionary will continue to lead some of that bounce. They were some of the biggest losers during this decline, including as well as energy materials. But they're all pushing higher. Communication services, not so much. All your safe haven areas down here. Financials also still struggling, not really moving up higher as the yield curve continues to flatten out a little bit. But again, we expect energy, materials, and industrials to lead as long as the dollar weakens. So if there's a continued trend of weakness in the greenback, then now we know what the sector moves are going to be. If I were to go back here, look at the comparison for the sectors. This is off of the low point. I can't show you on this chart because there wasn't a regular close on that Friday after the Thanksgiving, because we had a half day. So it kind of throws off the chart script a little bit. So we look here on profit charts. You can see since we've had that low point on Friday, the technology and discretionary areas leading the way strongly higher, 8%. Healthcare also beating the market. Energy, industrials kind of they were lagging. They've caught up. Materials saw some more room to catch up to get there. On the other end of the spectrum, financial still really struggling, kind of hitting hard with some bad news in the industries as well. Staples lagging behind, but still up 2.5%. Industrials lagging, but still up 3.5%. So these safe haven areas will lag during this type of market environment. But they'll still give you some gains. Remember, they've really outpaced, right? If you were to zoom out here and go from the high point on November the 8th, from when we peaked here, and then go through the lows and then back up to now, financials has held up the best, right? So it's been lagging behind during the run up here, but if you include the the drop down, then you can see it's really done. It's held up really well. Same with healthcare. Same with utilities. if you were to go from this peak that we had on the 16th through the near-term low, because that's a near-term high, through the near-term low up to the new near-term high, which is a higher high. Again, there's discretionary healthcare holding up through the downturn and the bounce, and then there's staples up half a percent there. Other materials and energy catching back up too after a deep decline. Technology really suffered during that near-term pullback. It's catching back up to up 1.5%. So when you include these, the drops and the bounces, then those safe haven areas hold up better. But when you're just looking at just the low point going forward, they're going to lag behind. So they hold their values really well during the downturns. They lag behind on the upturns, but when you put them together, they tend to show some relative performance, and that's why they do so well, especially when you include this. This doesn't include the dividend payments that a lot of those stocks, that adds to the return for a lot of those stocks. All right, for our trade idea of the day, I want to take a look at the semiconductor sector. We've done a trade here before. There's another stock, Micron here, that's breaking up above the highs of multiple low days, right? Potential double bottom here, getting in the upper half of the Bollinger Bandwidth for the first time in a while. If you take a look at the DMI chart, and let's pull up the other DMI indicators down the bottom, you can see, let's pull up Micron up McDonald's. There we go. So things are starting to improve. Not quite there yet, but the blue line is making its way back up above 20. The orange line coming back down below 25, showing some improvement on the histogram, which is measures the gap between these two. You take a look at the long-term chart, which looks really bad. The whole industry does, but you can see the long lower shadow we had last week. How bullish this move would look. So there's opportunity for this to make. We've had this death cross. We make a return move back into about that 44.5 area. To retest that 200-day moving average. Look at that two-line version of the chart. You can see the MACDs getting above zero. The 8 and 17-day moving averages both crossing above the 17. You can see the big divergence we had, equal lows with the higher lows in the MACD and stochastic. Stochastic's turning up above its moving average. You look at its market forecast indicator for Micron. The intermediate line turning above 50, the near-term line turning bullish. So it's looking more and more bullish. Not that we want to really back up the truck here, but as I mentioned, there's some volume resistance in this area. If I go back to the Bollinger Band, there's some volume resistance up here in this 43 up to 45 area. So can I make a trade there? Well, yeah, we can. Let's do this. Let's take a look at doing a 44. We'll sell the 44, buy the 42. So essentially we're buying an out-of-the-money call option in January, and then we're going to offset that cost of $1.85 by selling the 44. That caps my gains up to, that caps my gains at $44. I'm risking $64 to try to make $136. Okay, well, can we cover that $64 cost? Well, yes, we can cover it by selling another 144 for $1.15. Now I get a 46-cent credit, and by doing that, you can see I cap my gains. Now I can start getting a loss because I'll have a naked short call at 44. Because again, the odds of us getting above 44 are relatively low because of all the volume and the resistance that's in that area. Remember the 200-day moving average is up there too. But can we get up there and make a decent gain? Well, sure. We can, for 400, we got an 80% chance of making some money because we got the credit here. If it goes down, we'll make at least $46. 46 on 460 is how much is required to get into this trade. If I were to create this duplicate order, you can see it takes it for this margin account. It takes $460 to get into it. So, it's a 10% return kind of in the worst case scenario with a potential reward of $244 if we get up into this area and kind of stall out there. Of course, if we go too far, above 46.5, then I can start losing money. 46.5 is right there. Again, it had to blow through some pretty strong resistance, including the 200-day moving average for us to do that. So an opportunity to make a bullish trade, to get a decent return in the short term, in the worst case scenario, to get a pretty good return if it does do what we expect, knowing that it's going to have a hard time getting up here no matter what, no matter how bullish we are, because of all that overhead resistance it has. So that wraps us up for tonight. Now I want to hear from you. Remember to use that link that's above the video in the blog, in our Market Scholars blog. That takes you to our forums. And I want to hear what comments or questions you have from tonight's video. There's something that you see that we didn't cover that you want to share with the Market Scholars community. Remember, you can do that in the forums as well. And you can also respond to anybody's questions or comments that you see them posting. As always, thank you very much for watching. I appreciate your time as always. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment down below. Follow me on Twitter. Join our Market Outlook community on Facebook, as well as subscribe to our Market Scholars website for free so that you can participate in those forums. Again, thank you for watching. Have a great rest of your evening, and we'll see you all tomorrow.